Gold just dropped. After weeks of holding steady, the price suddenly moved lower, catching many investors off guard. Charts turned red, momentum flipped, and just like that, confidence started to shake. On the surface, it looks simple. Price goes down when demand weakens, price falls when buyers step away. That is the story most people see. But beneath that drop, another trend has been quietly continuing. One that does not match the idea of fading demand at all. Because while gold prices have been falling on the screen, central banks around the world have still been adding to their reserves, not selling, not pausing, buying. And that contradiction is where this story begins. When the largest, most patient holders in the system continue accumulating during price weakness, it raises a question that deserves attention. What do they see that the market does not? To understand why this matters, you need to understand who central banks are in this market. They are not traders chasing short-term moves. They do not react to daily volatility. Their decisions are strategic, slow, and often based on long-term structural shifts. When they buy gold, they are not trying to flip it next month. They are positioning for stability and security, and protection against future uncertainty. Over the past decade, central bank gold purchases have steadily increased, but in the last few years, that pace has accelerated. Countries that had not been major buyers before suddenly began increasing their reserves. Others that had paused for years resumed accumulation. This trend did not start yesterday, and it did not stop when prices became volatile. Even during corrections, the buying continued. At the same time, the public narrative has been focused on price action. Headlines talk about gold falling, gold weakening, gold losing momentum. And when people see those headlines, many assume the opportunity has passed. They assume the smart money has already left, but central bank data suggests something different. It suggests that while short-term sentiment shifts back and forth, long-term accumulation has not disappeared. This creates a disconnect between perception and behavior, because in most markets, falling prices discourage buyers, but here, some of the most powerful institutions in the world have continued adding exposure. That does not guarantee prices will rise tomorrow. It does not mean volatility is over, but it does mean the story may be more complex than a simple decline. Part of the reason this goes unnoticed is timing. Central bank purchases are not always visible in real time. They are reported later. They appear in reserve data after the fact, by the time the public sees the numbers. The transactions have already happened, the positioning is already in place, and the market has already reacted to other signals. This delayed visibility creates an information gap. Short-term traders react to price, long-term institutions react to structural trends, and sometimes those two perspectives move in opposite directions. Price becomes noisy, headlines become reactive, but the underlying positioning continues quietly in the background. This is not the first time gold has shown this kind of divergence. In previous cycles, there have been periods where prices moved sideways or down while official sector buying increased. Those periods did not always lead to immediate rallies, but they often marked phases where long-term foundations were being built beneath the surface. Because gold plays a different role than most assets, it is not just a commodity, it is also a reserve asset, a form of financial insurance, a tool used by central banks to diversify away from currencies and reduce exposure to external risks. And when uncertainty rises in the global system, that role becomes more important, not less. Right now, the global environment is full of shifting dynamics. Interest rates have moved rapidly over the past few years. Inflation remains a concern in many regions. Currency values fluctuate. Debt levels remain high. All of these factors influence how central banks think about reserves. And gold has historically been one of the assets they turn to when stability becomes more valuable than yield. So when prices fall but central bank buying continues, it challenges the simple explanation that demand is disappearing. It suggests that different participants are responding to different signals. Short-term traders may be reacting to momentum, but long-term institutions may be reacting to structural risk. And that difference matters, because markets are often shaped by the balance between short-term positioning and long-term allocation. When those forces move together, trends can be smooth and clear. But when they move in opposite directions, markets can become unstable, unpredictable, and difficult to interpret using price alone. That is the situation gold appears to be entering now, a phase where surface signals and deeper signals are no longer aligned, where price suggests weakness but accumulation suggests preparation. And when that kind of divergence appears, it is usually a sign that the market is in transition, not resolution. The important thing to understand is that central banks do not need to rush. They operate on timelines measured in years, not days. They can continue accumulating quietly while the market focuses on short-term fluctuations. And by the time the broader trend becomes obvious, their positioning is already complete. Which brings us to the key question. If gold is falling, but central banks are still buying, what exactly are they preparing for? And more importantly, what does that mean for the market in the months ahead? To answer that, you have to look at the bigger system gold exists inside. Gold does not move in isolation. It responds to interest rates, currency strength, liquidity conditions, and confidence in financial stability. When interest rates rise quickly, gold often struggles in the short term because yield-bearing assets become more attractive. Money flows toward bonds, toward cash instruments, toward anything offering immediate return. That shift can create downward pressure on gold prices even if long-term demand remains intact. But central banks are not chasing yield. Their objective is not to maximize short-term return. Their objective is to protect reserves against long-term erosion. And that distinction is critical. Because yield can change quickly, interest rates rise, then fall, bond values fluctuate, currencies strengthen, then weaken, but gold's DESI role is different. It is held not for income, but for stability when other assets become unpredictable. In recent years, global interest rate cycles have moved faster than many expected. Central banks raised rates aggressively to control inflation. That tightening strengthened certain currencies, especially the US dollar, and when the dollar strengthens, gold often weakens in price terms because gold is priced globally in dollars. So that relationship has existed for decades. It creates periods where gold appears weak, even though underlying demand has not disappeared. At the same time, global debt levels have continued expanding. Governments, corporations, and financial systems operate with higher leverage than in previous generations. That leverage works efficiently when growth is stable and confidence is strong, but introduces vulnerability when conditions tighten. Because higher debt means higher sensitivity to interest rate changes, refinancing pressure, and liquidity stress, central banks understand this dynamic better than anyone. They are not just observers, they are participants responsible for maintaining stability when they increase gold reserves. It is often part of a broader strategy to reduce reliance on any single currency or financial instrument. It is diversification at the highest level. Another factor influencing this behavior is currency risk. Many countries hold reserves primarily in foreign currencies, especially the US dollar. That system has worked for a long time, but it also exposes those countries to external policy, decisions they cannot control. Changes in interest rates, sanctions, trade tensions, and geopolitical shifts can all affect the value and accessibility of those reserves. Gold, by contrast, is not tied to any single government HS policy. It exists outside that framework. This is why central bank buying often increases during periods of geopolitical uncertainty, not because gold produces income, but because it represents independence. It is an asset that does not depend on another country promise to pay, and when uncertainty increases, that independence becomes more valuable. While all of this has been happening in the background, market participants have remained focused on shorter-term drivers. Inflation reports, interest rate decisions, employment data, these factors move price immediately. They create volatility, they shape sentiment, but they do not always reflect long-term positioning. This creates a layered market. The visible layer reacts quickly, the deeper layer moves slowly, and when those layers begin moving in different directions, price alone becomes an incomplete signal. Because price reflects the balance of buyers and sellers in the moment, it does not always reflect the intentions of buyers who are accumulating gradually over time. Another important piece of this puzzle is supply. Gold supply grows slowly. Mining production increases incrementally, not suddenly. Recycling adds some flexibility. But overall supply expansion is limited compared to financial assets, which can expand rapidly through credit creation. That means when long-term demand increases, it cannot be immediately matched by new supply. The adjustment process takes time. This slow supply growth is one of the reasons gold has maintained its role for centuries. It cannot be created instantly in response to policy decisions. It must be mined, refined, and delivered. That physical constraint creates a different kind of market structure compared to purely financial instruments. When central banks increase reserves under those conditions, they are not reacting to yesterday's price move. They are reacting to structural conditions that may unfold over years. They are positioning for resilience, not momentum, and it makes their actions fundamentally different from short-term speculative flows. Right now, that difference is visible, price has softened, momentum has slowed, but reserve accumulation has not disappeared. That suggests the decline may not represent a collapse in long-term confidence. It may represent a temporary phase where short-term forces are dominating headlines while long-term forces continue quietly underneath. This is why moments like this often feel confusing, because the signals conflict. The chart shows weakness, the reserve data shows accumulation, the headlines focus on decline. The positioning suggests preparation, And when markets send mixed signals, it usually means the next phase has not fully revealed itself yet. The key is not to assume immediate conclusions. It is to watch whether this divergence continues. Do central banks keep buying if prices remain volatile? Does accumulation slow if prices fall further? Or does buying accelerate during weakness? Those patterns often reveal more about future direction than price alone. This is where psychology begins to play a major role. Because markets are not driven only by data, they are driven by perception. When people see gold falling, they naturally assume strength is fading. They assume demand is weakening. They assume the move is over, and that perception can reinforce itself. More selling creates more fear creates more hesitation, and price continues to drift lower. Not necessarily because the long-term case has changed, but because confidence has temporarily shifted. But central banks do not operate on perception. They operate on positioning. They are not influenced by daily sentiment swings. They are influenced by long-term risk assessment. And historically, some of their most aggressive accumulation phases have occurred during periods when public confidence was uncertain. This creates an important dynamic, because while public participation often decreases during periods of falling prices, institutional accumulation can continue quietly. The visible activity slows down. The invisible activity continues, and over time, that quiet accumulation can begin to reshape the underlying structure of the market. It does not happen overnight. There's no single moment where everything suddenly changes. Instead, pressure builds gradually, volatility increases, price swings become less predictable. Confidence shifts back and forth, and eventually a new trend begins to emerge. Sometimes slowly, sometimes suddenly, but always after a period where signals appeared conflicted. Another factor to consider is timing. Markets often move ahead of public understanding. By the time a clear trend becomes obvious in headlines, much of the positioning has already happened. This is why accumulation phases rarely look dramatic while they are occurring. They look quiet, uneventful, easy to ignore. Only in hindsight do they appear significant. Right now, gold appears to be in one of those quiet phases, a phase where price weakness attracts less attention than price strength would. But beneath that weakness, reserve behavior suggests continued interest from the most patient participants in the system. And patience in markets often carries more weight than speed. None of this guarantees that gold will immediately reverse. Markets can remain volatile longer than expected, prices can continue drifting, sentiment can remain uncertain, but the presence of continued accumulation changes the context. It suggests that the decline is being observed, not abandoned, watched, not ignored. The real question is not whether gold fell last week. The real question is whether the underlying reasons central banks accumulate gold have disappeared. Because if those reasons remain, then short-term price weakness may represent something very different than long-term structural weakness. This is why watching behavior matters more than watching headlines, because behavior reveals intention, and intention over time shapes direction. If central banks continue increasing reserves while prices fluctuate, it signals preparation, not retreat. It signals that stability, independence, and protection remain priorities in an uncertain environment. And that brings us to the moment we are in now, a moment where the chart shows decline, but the deeper layer shows persistence, where sentiment shows hesitation, but positioning shows commitment, where the visible story and the invisible story are no longer the same. Eventually, one of those stories will align with the other. Either accumulation slows and confirms the weakness, or price adjusts and reflects the underlying demand that has been building quietly in the background. Until then, the divergence itself is the signal, because when long-term buyers continue accumulating during short-term weakness, it rarely means nothing is happening. It usually means something is changing. And the only way to see it clearly is to watch not just what the price is doing, but what the most patient participants are doing, while everyone else is watching the screen.